today we're going to talk about how the 1% legally pay little to no tax and what exactly that means. All right. So the three faces I have on the screen right now are three of the three billionaires. Most notably, we have Elon Musk first, Jeff Bezos, and Peter Thiel. Okay. So Elon Musk, his net worth is about $820 billion, right? And in 2018, his salary was $0. It actually still is to this day, but his net worth at that time was worth tens of billions of dollars. Jeff Bezos is worth about $244 billion, billion with a B. And he's had the same salary since 1998. You know what his salary is? Any guesses? His salary is $81,400. That's $81,000 is what he pays himself every single year for almost, I don't know, almost 20 years now. And Peter Thiel. Peter Thiel is worth about 28 billion now. For those of you that do not know him, I'll explain his story in a second. But he's a big investor. He's most notably known for his investments in PayPal, and he also is a big early investor into Facebook as well. So Jeff Bezos, back up for a second, 244 billion, $81,000 salary, right? One of the richest men alive. And he paid zero federal income tax in 2007 and 2011. 100% legally did this the right way. How did he do this? There's all different ways, right? It comes down to the assets that he had in place. We're going to get into some of those strategies today, but one of the most notable examples is the small salary that he pays himself, and he borrows against his stock in the company because loans are not taxable, but income is. So instead of him paying himself millions of dollars, he's able to borrow against his loans, which is against his stock. And the same method that Elon takes, right? And this is only the things that we know publicly, right? We don't have access to their private taxes, but publicly we know that they have a wealth in their stock and they borrow against their wealth. So they can keep accumulating that stock. That's how he pays himself. Elon pays himself $0 in salary when he's worth almost $1 trillion, one of the most richest men in the world. And it's because his growth in his stock grows tax-free as long as he's not doing any capital calls or pulls out, and he borrows against his stock as well. And Peter Thiel, who's Peter Thiel, right? So Peter Thiel is known for one of the smartest tax strategies that exist. He took $1,700 and turned it into $5 billion. The best part is 100% tax-free. All through what's called a Roth IRA account, okay? If you know traditional and Roth, Jason will get into that later, but essentially anything that comes out of a Roth is tax-free, okay? And there's limits on that, right? How could he even get $5 billion into a Roth IRA? Because that math doesn't work when maybe the max is $7,000 a year. But what he did was in 1999, he opened up a Roth IRA and he bought $1.7 million worth of PayPal, right? $1.7 million at 0.001 1 cent, per share. And its total investment was $1,700. Then 3 years later, eBay bought PayPal and he didn't cash out. Instead, he kept accumulating it and every dollar stayed inside the Roth. And then he put $500,000 into Facebook, really, really early adapter, also came inside the Roth. And as that grew, then he continued to reinvest, right, into other things like SpaceX, Airbnb, etc. And every time he did that, all the money would go back into his Roth and accumulated wealth and would come into this tax-free wealth vehicle. It's not that they're smarter than you. They may have more money than you, but what they have is they have information that maybe we do not have. And that is coming up with the strategic strategy in place and having some of the best advisors in the world that are very, very forward thinking. The way that I like to look at it is there's two different types of players in this world, right? We have the 99% and the 1%. We all have heard that before. How do we think like the 1%? How do we make moves like the 1%, right? So the alternative to that is the 99%, which is where majority of the world falls into that bucket. But everybody idolizes this 1%. Maybe they have more money than you and they pay less taxes than you, right? How is that fair? How is that legal? So who falls into the bucket of the 99%? These are the people that we live paycheck to paycheck, right? We pay as we go. And maybe we have some investments like a company 401k. We're putting in the minimum. Maybe some of us are even maxing that out, just leaving it in there until we hit 59 and a half, until we retire one day and we can touch it. And maybe we have a house, a primary house, and maybe we have one investment property, but we're not strategizing and utilizing it to maximize and optimize for our tax scenario, right? Maybe we invest in some other things and we're a little bit more advanced, like having some stocks or index funds as well, right? And what does our tax strategy look like? We're filing every once a year. Maybe there's a few things that we take advantage of, like obviously the standard deduction that we're all eligible for, right? We're going to hope that our accountant finds something. We're relying on whoever's filing our tax return to tell us our destination when it comes to our taxes. And we're not really making moves all year round, right? But we want to get to that destination where we don't want to put all this work in just to play the tax game, right? That's not fun. Taxes suck, right? We don't want to pay taxes, right? Nobody wants that feeling of paying the government, but we are entitled to our fair share of our earned income and keeping what we earn right into our pockets to a certain percent, and the government is entitled to a certain percent as well. But there's information baked into the tax law that makes you eligible. They just don't give it to you in plain sight, and they're not going to give it to you on a platter. You're going to have to look for it yourself. So the more you know, the better. And commending you guys for being on this tier today. I keep wanting to say tonight, but we're in the middle of the day today, and you're already taking the next step to get to that 1%, right? And 1% doesn't necessarily mean wealth. It also means knowledge, right? It also means strategy. It means decision making. So looking at things year round, looking at planning in advance, looking at tracking as we're doing this, looking for growing our empires, but not just growing them from a revenue standpoint, but growing them in a tax efficient manner, right? The least that we can pay in taxes legally as possible without putting in too much work as we make those decisions as well, right? Choosing the right entity structure in place. It's not a set it and forget. You don't choose an LLC or an S corp and say that's it for life, right? As we grow and circumstances change, so should our modeling and so should our strategy. So these are all things we're going to jump in today, looking at proactive strategies, looking at structure and intentional decision making. And Jason and I spoke about this before we jumped on, and I'm going to introduce Jason in a second. Jason and I talked about how can we make the best experience possible for our clients. As owners of our CPA firm, well, we're called Oro Tax Advisors. We have all different strategies that we put in place here for our clients. And everybody wants to get to that end route, that 1%, but they're not necessarily taking the steps that come before it. You're not going to, when it comes to building a house, you're not going to go and build the roof first, right? You're not going to build a roof and lay it on the ground and say, let me build the house and the foundation around the roof. We have to start with the foundation first, okay? And the foundation is going to be extremely important. And then we start building the floors, and then we start building the walls, and then we build the roof, and then we put in the accents, and then we build out all the interior design step by step, right? You're not going to have the final result if you try to start backwards. So our goal is to try to make this as seamless and easy and achievable as possible as we build out plans for our clients. And today we're going to give you a lot of great information and free knowledge. So let me introduce Jason Lafser, and I'll tell you a little bit about our firm as well. Let's first have Jason come on. Jason is our managing partner. He's a CPA over at Oro Tax Advisors. As I mentioned, we have a tax firm. We specialize in tax planning. We also do tax returns and normal things too, but we really are focused on proactive strategies. So Jason just recently actually got awarded for the second year in the row. Was it Forbes 2026
Uh,
Best in Business?
Best in state
Best in
CPA,
state. Okay.
for the state
Yes,
of
we were
Florida.
really excited to see Jason get that. And he's on the Florida Board of Accountancy as well. Jason, jump in and come say hi.
Yeah, thanks for that introduction, Danielle. I've been a CPA for going on, I guess going on 20 years, 15 to 20 years, but been in public accounting basically my entire career. And, whenever I first met Danielle, I wasn't really looking to make a move. I've been in a traditional CPA firm, again, basically since I graduated college and had a great experience there, learned a lot, had a lot of great clients that I worked with for a long time. But I'd been through the process of, being with a smaller regional firm here in Jacksonville. That firm got acquired by a national CPA firm. And so whenever that happened, again, it was a great experience. I learned a lot. But I got pulled away because, again, a larger firm, you move upstream from a client base standpoint, and got pulled away from working with a lot of entrepreneurs and small business owners that I had done the first half of my career. And so whenever I met Danielle, she kind of explained what the vision she had, and, hey, we want to be, I think a lot of CPAs say we're proactive advisors, we're, on the cutting edge of any tax law changes and that type of thing. But in practice, you don't see that a lot. I think that's the number one complaint we get when we talk to new clients is, I can't get in touch with my CPA or they're not proactive. Like I'm bringing strategies to them. And so, one of the things that we talked about was we want to actually do that. And so again, Danielle mentioned we lead with advisory, and that's where we like to spend the majority of our time is planning with clients and how can we do things now to impact your year so that when it does come time to file the return, which we do as well, you're not playing defense, if you will. You're playing offense throughout the year and implementing a lot of the things that we'll talk about today, so that you get to the end of the year, you're not surprised with the tax bill, and when you file that return and sign your name on there that you've done everything that you can to pay as little as legally possible. So.
Wonderful. So, for those of you who are listening in, again, this will be a lot of information, but we're going to go through this quick. And we do have a community. I'm not going to drop it yet. We'll drop it later. For those of you who are not in here, every Wednesday night we do live calls specifically on different tax topics. And if you can see my screen, this is an example of some of the things we talk about. On the foundation, we have more of the operational items, entity structure choices. On the level two, as you graduate from that, then we'll go into some of the retirement tax-free growth vehicles, even maxing out real estate tax strategies. And then in the level three is the roof. And that's where we talk about protection from assets, from legacy, from what you want to pass down. And that looks different for everybody's wish list. We can't cover all that today. We'd have to be here for a very long time, but we will cover as much as we can. And we want to get you through those foundational and the walls to break through so that you can get through this entire house built the way that you want it set up for yourself. So that being said, for today, we will jump into these 5 strategies specifically, and we will go in as much detail as we can in the limited time that we have. The first thing that we'll talk about is going to be the entity structuring and choice. The second thing we'll talk about is how to rent your home to your business, income tax free. The third thing we'll speak about will be tax-free deductions. The fourth thing will be to turn passive losses into active income shields with real estate. And the fifth topic will be tax-free wealth building accounts. That being said, I'm going to turn this over to Jason to jump in to get us started. Make sure you have your workbook open and you take notes as we go along. We'll be answering questions as we see them come up when we can in the chat. Otherwise, we'll do a live Q&A for the remaining time at the very end.
Okay, so entity structuring, I think, is one of the things that we get questions about a lot, and it makes a lot of sense because, I think the type of structure that you are, it impacts so many things, and so it's never a one size fits all. And so I think a lot of times, people will get out of the gate and they start a business and they're like, oh, I've got to be an S corporation, or I've got to be an LLC, or I've got to be this or that. And so, a lot of times, we'll have clients that will come to us after the fact and they're like, hey, I already set this up. I'm an S corporation and I'm off and running. And, we have the conversation. And again, sometimes you can do things to fix that or change that. And sometimes maybe that's the right answer. But we like to look at it holistically and say, okay, well, one, let's understand the difference between the different types of entities. And I think there's this, lack of clarity around, okay, well, should I be an LLC or should I be a corporation? Or should I be a S corporation or should I be a C corporation? And so I'm gonna like strip it back to the basics because again, I think sometimes there's just a lot of confusion around, what is an LLC versus an S corp, and can an LLC be an S corp? Can an LLC be a C corp? And the answer is yes. And so, to go back to the beginning, a lot of times I think too, people just make a decision, right, without thinking about what do I want this business to be? And at the end of the day, like, how do I want to get out of this business? And so it's completely understandable. A lot of times you may not even know that, right? When you're starting a business, you think, I've got a great idea for a product or a service. And, maybe you're still working a full-time W-2 job and you're doing something on the side and you're not sure, you hope it'll be successful, you think it will, But you just want to get something up and going so that you can start generating some revenue. And so you're not necessarily thinking about, well, is this a business that maybe I'm going to ask other people to buy into at some point? So I'll have partners or other owners at some point. Is this something that I'm trying to build and I want to work here for the next 20 years? I want to quit working my W-2 job and I want to work in this business and have it provide for me and my family. Are you building something that you want to turn around and sell in 5 years? Or maybe you're building a business that you want to grow, provide for your family, and you want to hand off to your children or grandchildren one day. And so it's difficult, obviously, to have answers to those questions when you don't really know what the future holds. But I do think it's a worthwhile exercise to at least be thinking about some of those things, even when you're in the beginning stages of your business, because again, there are some things that you can change midstream as it relates to your entity structure, but there are some things that you can't, or maybe you could, but it would cost you, right? And so, if you know, hey, I'm going to build this business for 5 years and I want to turn around and sell it, well, that may impact the type of entity that you have versus somebody that says, I'm gonna start this business and this is gonna take the place of my W-2 job. I'm gonna work here for 30 years and then I'll either close it down or sell it or whatever. I'm not worried about the exit so much. So anyway, I just like to mention that as something to think about. Again, I completely get it. You may not know the answer to that, but again, I do think it's worthwhile to go through it. So, one common thing that I see a lot of people maybe a little bit of a misunderstanding on is the type of entity and does an LLC make sense or does a corporation make sense? And what we see most of the time is that an LLC is usually optimal for most people because it adds a lot of flexibility. So I see there's and the reason most people will choose the LLC is because again of the flexibility. So an LLC by default, if it has one owner, it is what is considered a single member LLC. And so for most people that are just starting in business, that is what is going to make the most sense. So from a tax standpoint, there's really no difference between operating as a sole proprietorship and operating as a single member LLC. The big difference comes when it relates to liability, right? So LLC stands for limited liability company. So when you're operating a business just as a sole proprietorship, you're operating as yourself. So if I was going to start an accounting business and I was just going to do it as Jason Lafser, CPA, and I didn't want to set up an LLC, I could do that under my personal name, my personal social security number. The problem with that is that if I were to do something wrong, I'm on the hook because I don't have an LLC, and so I'm the one that's liable for anything that happens. The LLC gives you that extra layer of liability protection, and it also allows you the flexibility. So an LLC, by default, again, if there's one owner, it's going to be taxed. It's what's called a single member LLC, and the IRS considers that a disregarded entity. And so what that means is essentially that there is no separate tax return that you have to file for that LLC. So again, very flexible, not a lot of administrative burden on a small business owner, but you can also elect as an LLC to be taxed as a C corporation. You can elect to be taxed as an S corporation. So again, it gives you that flexibility where maybe you say, I don't need to necessarily, I'm not at the level yet, and we'll get into some of those considerations. I'm not at the level yet to make an election to be taxed as an S corporation yet. I'm going to operate as just a single member LLC. All the activity of that just gets reported directly on my personal tax return on Schedule C. And again, as I grow, maybe I'll do some analysis to see when does it make sense for me maybe to make an election to be taxed as an S corporation. If you have more than one owner as an LLC, by default, that is going to be taxed as a partnership. So again, single member is a disregarded entity, multi-member is default taxed as a partnership. But again, if you have a multi-member LLC, that LLC can make an election to be taxed as an S corporation. It can make an election to be taxed as a C corporation. So again, you see the flexibility in the LLC that again, if you file as a corporation when you set your business up, and again, this is a filing that's done with the state, not with the IRS, that if you file and set up a corporation, you're limited. You can either be a C corporation or again, which would happen by default, or you can make an election to be taxed as an S corp. So you could not be a partnership as a if you set up a corporation, you would need to be either a S corporation or a C corporation. So again, the LLC adds flexibility from a tax standpoint with the single member. 100% of the net income is subject to self-employment tax. And so that's where we see, again, if you're just starting a business because of the lack of having to file a separate tax return and some of the other administrative costs, that sole proprietorship or single member LLC probably makes sense at the beginning. And then as you continue to grow that business, um, you'll get to a point where you say, okay, hey, look, it probably makes sense because I'm getting hit with all of this self-employment tax. If I were to make an election to be taxed as an S corp, I could possibly save some tax. So we'll get into an analysis of that in here in a minute. But again, it may not make sense right away because when you make that election, there are certain other things that you have to do as an S corporation that not necessarily add tax cost, but add administrative costs. So again, with an S corporation, you're filing a separate tax return. There's a cost that's associated with that. You have to pay yourself a salary. There's an administrative cost that goes along with that. There's also the FICA taxes that go along with that. And so again, it may make sense, but it doesn't always make sense. And that's one of the things that we see people miss a lot of times is making that S election too early when maybe they could have just continued to operate as a single member LLC or a sole proprietorship and would have not necessarily cost them anything extra. The last thing I'll add on this again with the partnership, again, the LLC and partnerships specifically, if you've got multi-members, a lot of times that will add additional flexibility when it comes to allocations. So if you've got an entity, for instance, where you've got multiple partners and you don't want to allocate everything pro rata based on ownership, that's a big distinction between the S corp and the partnership. With an S corp, everything is allocated pro rata based on ownership. So if you've got two 50/50 owners, the income or the profit is allocated on their K1 50/50. The losses are allocated 50/50. If you make distributions, those have to come out 50/50, or whatever that ownership is. So that's a big distinction between the S Corp and the partnership. The partnership allows a lot more flexibility when it comes to allocations like that. So if you've got an instance where, one partner's putting in the money, the other partner is putting in, sweat equity or something like that, and you say, the first partner that put the money in is going to get allocated the first, maybe the partner puts in 100 grand. He's going to get allocated the first $100,000 of losses, or he's going to be entitled to the first $100,000 of distributions. Then that flexibility is allowed in a partnership where it's not allowed in an S corporation. All right, let's go to the next slide, Danielle. So again, the S corporation, I alluded to this a little bit earlier, and I do see some questions coming in the chat. Continue to put those in there. We will have time for Q&A at the end. So, keep the questions coming. I may not get to them as we're speaking, but we will have time for Q&A at the end, and we'll come back to those. So keep the questions coming. But I want to talk about the S corporation and specifically um, the self-employment tax place. So I alluded to this a little bit earlier that, sometimes it makes sense to make that election and make the jump to an S corp because again, as a sole proprietorship or as a single member LLC, you're operating, you're generating profit, and every bit of that profit, and I say every bit, at least every bit of it subject to income tax, and every bit of the profit up to the first 184.5 is also going to be subject to the full self-employment tax. So again, think of self-employment similar to the FICA taxes that you pay on salary. There's the Social Security piece of it, there's the Medicare piece of it. So with self-employment tax, it's the same tax that you would pay as a W-2 earner, that Social Security and Medicare. There is a limit on the full 15.3%. So you pay that full 15.3% on the first 184.5, which is again Social Security limit for 2026. And then the 2.9%, which is the Medicare piece on anything above that. In addition, this is in addition to the income tax, right? So you can see as your profit grows with a sole proprietorship or with a single member LLC, that's when it starts to make sense. Okay, can I make an election to be taxed as an S corporation? Because what happens when you make that election, right? You now get your income split into the two buckets that you see. And so when you take profit out, that can come out either as salary, and you do have to pay yourself a salary as an S corporation owner. But the other piece is I can now take subchapter S distributions. And those distributions, while they're subject to income tax, because again, essentially the the corporation itself doesn't get a deduction for paying those out, those are not subject to the self-employment tax. And so you see there is a savings there by structuring what amount am I taking in salary, what amount am I taking in distributions. So we've got an easy, quick example in the middle there. We've got an entity that's making $200,000 in profit. If I was just operating that as a sole proprietorship, everything that's coming out of there is coming out to me. I'm paying income tax on the full 200. I'm also paying that self-employment tax like we talked about on that. Now, if I were to make an S election and instead am taxed as an S corp, I can take a salary that's reasonable. And so again, I say for my situation, an $80,000 salary is reasonable. That salary is taxable income to me. It's deductible by the business. It's also going to be subject to that Social Security and Medicare tax. But I can now take that $120,000 out as a distribution. That $120,000 distribution is not subject to that self-employment tax, not subject to those FICA taxes. So just by taking that profit out as a distribution instead of salary or instead of, essentially single member LLC or sole proprietor income, I can save up to around $18,000 just by making the election. Now, again, remember, there are the administrative costs that go along with that. You've got to pay somebody to do a tax return. You've got to set up payroll, and so there's costs that go along with that. But even if you say it costs you, $5,000 to file a separate tax return to run payroll, you're still coming out ahead in tax savings by just making that one switch. Now, again, there are situations where there are things that you've got to look out for, right? So the IRS knows that, again, this is not really a loophole, but people will take advantage of this ability to take out these distributions, right? And so the key is finding a reasonable salary. And so that's the requirement as an S corporation owner. You've got to pay yourself a reasonable compensation. And so it is a gray area in the tax code. There's no definition of what constitutes reasonable. So it's going to be based on the facts and circumstances. What services are you providing to the company? What would you pay somebody else that you hired to do what you do? And so that's where, especially if you're trying to ratchet that number down as low as possible, having something like a compensation study done is a good defense to, setting a salary as low as possible. But we see this a lot of times, someone will come in and we'll look at the return and they're, generating two or three hundred thousand dollars in profit, and they're paying themselves, $10,000 in salary and taking out, $200,000 in distributions. In most cases, the IRS is going to say that's unreasonably low. They know that this is an area where people will play the game to try and avoid that self-employment, that FICA tax. And so again, you want to have some type of substantiation for what your salary is. And again, it doesn't have to necessarily be that full compensation study. But if you've got, data from Glassdoor or Indeed or something like that, that you can say, hey, look, here's what the going rate is for somebody in my position. Those types of things all factor into that. The other thing too, if you've got people that work for you that are generating revenue, um, then yep, we can see that. Yep, sorry, Danielle. We can, if you've got other people that are generating revenue for you, that factors into the ability to pay yourself a little bit less in salary, right? So if you're the only one that is generating revenue for your company, a lot of times the IRS is going to try and argue everything that is paid to you should be compensation because you're the one that's generating the revenue. So the fact that you can bring others in to generate that revenue and say, hey, look, I'm really stepping back from the revenue generation. I'm running the business. I'm operating as a CEO type, and I'm not out client facing. All those factors kind of go into, being able to pay yourself a little bit less in salary. Um, the last thing I'll mention on this, and it kind of goes into the LLC versus S corp. A lot of times we talk about the LLC being a benefit because, especially when it's a single member, like we talked about, there's less filing requirements. Watch out for there are some states like California, for instance, where even if it's a disregarded entity for federal income tax purposes, the state of California and some other states make you file a separate LLC return for that disregarded entity. So make sure that you're watching out. Again, besides the low salary piece, there are some state requirements that you've got to look at as well. All right, let's go to the next slide, please. I want to spend just a quick minute on qualified business income deduction. And again, this is something that is applicable to the various different types of entities. So again, whether you're sole prop, single member LLC, S corp, partnership, the one that it does not apply to is the C corporation. And so this is something that came into play when they passed the law to reduce the C corp tax rate down to 21%. They put this QBI deduction, qualified business income deduction, in play as a benefit to those flow through entities. Because again, if you're in the highest tax bracket and an owner of a flow through entity, you may be paying up to 37% federally on that income. So this was a way to help lower the rate without actually lowering the rate. But essentially, what this equates to is a 20% deduction on your qualified business income. This is something that was made permanent by the One Big Beautiful Bill Act. So it was set to expire. It is now permanent, which is a great thing. And really the thing that I wanted to mention on this specifically is that it's very easy to check to see and make sure that you're getting the full benefit of this deduction. And so we see this a lot as we review returns and we'll get into the different factors as to why you may not get the full 20%. But it's an easy calculation. You look at your business income and make the math easy. If you have $100,000 of business income, do you have a $20,000 QBI deduction? And if not, then it begs the question, okay, what is coming into play that is limiting this deduction? And that's where the planning comes into play, right? Because depending on the type of business that you have, if you have what is called a SSTB, a specified service, trade, or business, there are certain things that could factor into limiting that deduction. And so again, those SSTBs are things like, law, accounting, any type of medical practice, consulting, any of those entities where your expertise and your knowledge as an individual are driving the revenue, a lot of times those will fall under that specified service, trade, or business. If you don't fall within that SSTB, then there are still limits again based on some of these phase outs that we'll talk about, but it's not as restrictive as the SSTB situation. This is one of those I a lot of I worked a lot in healthcare in my prior firm, and so I always got the question like why did we get singled out? And again, I'm in the same boat as you were, right? I'm a CPA, attorneys, things like that. We're all in the same boat. And I think a lot of times it comes down to, lobbying, who's got the best lobbyists when they pass a law. And one of the things that was really funny is right before the law passed, there was like engineers were something that were considered SSTBs. And then like right at the last minute, they got a carve out so that now they're not SSTBs. And I've always made the joke, they must have a good lobby at NDC because they got, carved out right at the last minute. So But the last thing I want to focus on this specifically is again just almost like a checklist item for you. Look at your return, look at your business income, multiply that by 20%, and if you're not getting that full 20% business deduction, there's something that is limiting that. And so that's where a lot of the planning that we do at Oro comes into play, because a lot of times, clients don't even understand, well, why am I getting limited? And it may be something like, maybe you're not paying yourself enough of a W-2 salary, so that the sometimes the W-2s, the salaries that you pay to you and your employees, can be a limiting factor in the amount of the QBI deduction that you get. So specifically, if you're the only employee and you don't have a lot of assets, for instance, we've seen instances where people try and take advantage of what we just talked about, right? Pay a low salary so I avoid those FICA taxes, without the understanding that, okay, well, that may also limit your QBI deduction, because those W-2 salaries are a factor in how that is calculated. So you may be thinking, hey, I'm doing a great job of saving taxes by paying myself a low salary. I'm avoiding those FICA taxes. But on the back end, you may be limiting yourself from a QBI deduction standpoint. And if you paid yourself a little bit more, you're going to get much more of a QBI deduction that would more than offset the payroll taxes that you would incur by bumping that salary up. So again, there's a lot of moving pieces in that, and we could probably spend a whole hour on just the QBI deduction. But I just mentioned that to because again, I think a lot of times people miss that. They think I'm gonna avoid these payroll taxes. I'm gonna put my salary as low as possible, and they're kind of, shooting themselves in the foot because they're limiting things like the QBI deduction. So that type of like next level planning is where we really shine through, and where we can really bring value to our clients at Oro. So again, I'll put this slide up, but what I will say is that part of the resource that we've got for you guys today, and I'll kind of maybe mention this a little early, but part of the resource that we have is going to go through a lot of those things. Danielle shared a slide that had the visual of the house, right? And so she mentioned you've got to build the foundation before you can build the walls, and you've got to build the walls before you put the roof on. So we built a resource that will kind of walk you through those different stages. So stage one, maybe I'm a solo entrepreneur. I'm just starting out. I want to be a sole proprietorship, or a single member LLC. What are some things I can do at this level? Okay, now I've made the chance to, I've gone up to that S Corp. What are some things that factors into, should I be an S Corp? Should I be a C Corp? And so we built a lot of these questions that go into how to decide what entity you should be into that tool that we'll offer you guys at some point today. So things like that, things like some of the other stuff we'll talk about will be part of that tool, but I just wanted to kind of give you a sneak peek of that.
Jason, can I just jump in for one sec?
Yeah.
Neither you or myself actually mentioned this. I know we're speaking to a lot of business owners at the moment. Now, we are going to cover some strategies that individuals are eligible for as well. So hang on tight. We're starting out with some of the structure stuff, but in a few, we're going to be getting into some things that whether you're a business owner or not, it's mind blowing from tax optimization standpoint of what you could take advantage of. The tax code, as I mentioned earlier, was written for us to find different strategies in there that it's not given to us on a platter. And it definitely is written for business owners. If you're a business owner, you're going to get the max optimization when it comes to strategy and planning. So as we go through this, and you're in a different stage, maybe some of you are W-2, or maybe some of you are aspiring entrepreneurs. Having this information ahead of time is going to be inequivocally useful for you, right? So that you can make the proper decisions in a more advanced strategic way than most people just roll in because they have a hobby and they roll it into maybe a solepreneurship with a DBA, and then they keep it that way as their business has revenue and income and don't pay themselves correctly or put them on salary. So as we go through this, we're going to get real advanced real quick. You're going to see we're going to move fast through this. But I want to let you know that if you are an individual, there will be things on here as well. But again, the code is definitely written to optimize for business owners. So keep that in mind as you make decisions in the future.
Yeah. So again, a lot of this we've hit on already, so I'm not going to beat it to death, but things that you want to consider. We talked about reasonable salary. for S corporation owners, and there's an optimization that goes into that, right? And so you don't want it to be too high, you don't want it to be too low, and there's somewhere in the middle that's usually the sweet spot from both a tax saving standpoint and from a defense standpoint in the event that you ever were to get audited. Um, Things like, home office and auto deductions, there's different ways that you can do that, whether it's via an accountable plan, and the type of structure that you have sometimes will play into the best way to reimburse yourself for things like that. Retirement plan selection, obviously, that will come into play as you look at the type of entity that you have. Do you have employees? Do you not have employees? And again, how complex do you want to get it? And how much do you want to put away? And we'll spend a lot of time on retirement plans and different types of those tax-free accounts at the end as well. And then lastly, I mentioned, the type of holding structure, the type of business that you have and what you're doing. And again, like I mentioned at the very beginning, how you want to eventually exit, if you are thinking that far along, can definitely weigh into the type of entity that you put in place. All right, let's go on to the next one. So this is one we want to hit on for sure. This is applicable. It's applicable. Danielle mentioned it just before this. This is something that can be done if you're a W-2 only. It's really, really powerful if you are a business owner. But this is something that we have a lot of questions about. It's all over the place on social media. So there's a lot of information that's out there about the Augusta rule, some of it good, a lot of it not so good. But this is one of those examples where even without a business, you can take advantage of this. And so essentially, the Augusta rule, the way it works is you are allowed to rent your personal residence to your business or any other business or any other individual for up to 14 days per year tax free. So this is something that came into play. It's got the name the Augusta Rule because it really started in Augusta with the Masters, and people were renting out their homes the week of the Masters. And so again, it is very powerful when you also layer in a business that you own, but you don't have to have a business. So if I'm a W-2 only, I can rent my house for 14 days to anybody that I want. And as long as it's 14 days or less, I do not pay tax on that income. Now, there's keys to that. It needs to be fair market value. You need to, have a rental agreement in place and all that. But again, where this becomes doubly powerful is when you are renting your personal residence to your business. Because what happens again, the business pays the rent to you. The business gets a deduction for that rent. You individually don't pay income tax on that rent. So you get the best of both worlds. You're reducing your business income and you're moving that income to you personally and not paying tax on it. And remember, we just talked about S corps. How do you get money out? You pay yourself a salary. Well, okay, you get one, right? Deduction by the business, but you're paying tax on that income. Distributions, that's not deductible by the business, but it's not income taxable to you, right? So again, you get one but not the other. With the Augusta rule, as a business owner, you get both. The business gets a deduction, you get the income tax free. Now, again, the important rules you'll see at the bottom must be legitimate business use. So this is one where we do a lot of consulting with clients on like, hey, can I do this? Can I do that? What makes sense? And so, it's got to be true, legitimate business use. Shareholder meetings is a good one. Any type of company parties or things like that, that's another good one. A lot of times, think of the things where, hey, this is something that I need or want to do off-site anyway. And maybe I was going to rent, a space at a hotel or a space at an event center to do this company event or company party. Okay, well, maybe I can do that out of my home and I get the benefit of that. It's still deductible by the business. But again, it does need to be legitimate business use. Documentation is going to be key. This is something that we talk about with almost every one of our clients, even the ones that are already doing this. a lot of times they're doing it, but the documentation that they have is not what I would call ideal. And so again, you want to have a rental agreement in place between you and the business saying, hey, here's what the fair market value is, here's what the rental rate is, here's the dates that we're going to use, and have all that documented. You want to have minutes of the meeting. What did you talk about? Who was there? What business activities were generated? So you want to make sure, again, all of that is documented. And then finally, the fair market value. It's got to be fair market value. So that's where we spend a lot of time helping clients get those rental agreements in place, help making sure that they've got, templates that they can use to make sure the meeting minutes are documented. And then finally, making sure that they're using a good fair market value and something that would hold up if it ever were to get looked at. The last thing I want to mention on this is the 14 days. That's very important because what happens is if you go over that 14 days, then you would think, okay, well, logically, I can get 14 days free. If I rent it for 15 days, maybe I pay tax on that one extra day. That's not the way the rule works. If you go over 14 days, even if it's just by one day, now all of the days become taxable. So that 14 days is very critical to document and make sure that you stay under because again, once you go to that 15th day, now all 15 days that you've rented your property out are all taxable. So very key to keep under that 14 days. Let's go to the next slide. Okay, so we're gonna move on and talk about kids on payroll. This is another one that comes up a lot, and this is really one of my favorite strategies because there's multiple pieces to it, and the tax savings is a big piece of it. But to me, that's not even the best advantage to this, and so that's why this is really one of my favorite strategies. Again, it's one that there's a lot of information out there and we see it done not um not I don't know if adequate's even the right word, not ideally. And a lot of people doing this kind of, just not the proper way. But again, very powerful. And this is something again that, can set your children up in a great advantage and a great opportunity to really build wealth from an early age, in addition to teaching them all the things like work ethic and things like that. So why put your kids on payroll? So these are some of the real benefits, right? You're shifting income to a lower bracket. And so again, think about it. You've got a business, your business is generating profit. If you're in the highest tax bracket, you're going to be paying tax on that 37%, maybe even higher if you're in a state that has state income tax. By paying your kids, you're getting a deduction again for your business. So you're lowering the tax that you pay and you're shifting it to them. And again, because of the standard deduction, which is now 16 around 16,000, 16,100, as long as they're under that standard deduction amount, they essentially could pay zero tax. So you could go from, paying 37% on that $16,000 to paying 0% on that $16,000. Now, one of the things that I also like to mention to clients is, everybody gets infatuated with that standard deduction amount. And so we see a lot of clients that say, I'm going to pay my kids exactly that, and I don't want to go a dollar over that because, then they'll have to pay tax. And I say, yes, that's true. But what if they paid 10% on that? Right? Is that the worst situation? It's still a lower tax rate than you. And again, if they have the ability to use that money, and again, think about it. Maybe you pay them 20,000, right? They're not paying 10% on the full 20,000. They're paying 10% on the amount that's over the standard deduction amount. So it's still going to be a very minimal amount of tax, you're still getting that tax rate arbitrage because you're taking it out of your tax rate and putting it into their lower tax rate. So even if it's higher than zero and it's 10% or even 12%, it's still going to be a better situation, a better tax result than paying it at your high income tax rate. One of the other benefits of this is if you've got a sole proprietorship or a single member LLC and your kids are under 18, then the wages that you pay to them are not subject to those FICA taxes. So there's even more savings that they could get because again, if you've got an S corp, for instance, they will get paid through payroll just like anybody else. And as it comes out from an S corp, it is going to be subject to those FICA taxes. So there again, there's a little bit of cost in there, but they're still not going to be subject to that income tax. To me, number three here is the biggest benefit, the ability to fund a Roth IRA. So one of the requirements to fund a Roth IRA or a traditional for that matter is you have to have earned income. So to me, not only are you getting the benefit of putting this income in a lower tax rate, but the ability for your children to now fund a Roth IRA. And again, even if you're not funding it at the maximum of $7,000, like I just had this situation, my oldest is 18 and he started his own business. He's just doing lawn care, right? And so this was the first year that he did it. And I said, look, you've got to file a tax return and pay a little bit of tax. His income, he's a sole proprietor, right? So he's not making enough where it makes sense for S corp or all that. So I said, you're going to have to pay a little bit of tax. And he was like, oh, I can't believe this. I just don't want to file. And I'm like, no, you have to. Again, that's the CPA in me. Even though he probably could have got away, most of his income is coming in cash or Venmo. But again, I said, look, besides the right and ethical thing to do is to file the return. You want to file that return to substantiate that you had earned income because now you can contribute to a Roth IRA. And so again, even though his income wasn't enough to get to the maximum of $7,000, he was able to put money into a Roth IRA. The way I explained it to him is I said, look, let's go to ChatGPT and I want you to plug in there if you put, whatever the amount was, $3,000 into a Roth IRA now, even if it's just in a mutual fund. We'll get into self-directing and all that in a little bit later, but even if it's just in a mutual fund, how much is that going to be worth if you don't put anything else into it for the rest of your life? Put money into it now. You're 18. If you never put another dollar into that as a contribution, how much will that be worth when you're 60 years old? And we ran the math on that, and he was like, "Oh, wow." And so again, that to me is the best benefit of being able to put your kids on payroll, the ability to fund a Roth IRA and really set them up to for significant wealth creation at an early age. Next slide. So again, this is where, kind of the rubber hits the road and as they say, the devil's in the details, right? So one of the things that we talked with our clients about a lot is, what's the right age? What type of work can they do? How often do I have to pay them? Do we have to actually pay them, or can we just, make a journal entry to do that, or do it on paper? And so, you know, I was actually talking with a client yesterday, and not about this specifically, but just about some different strategies. And, anything that is going to be worthwhile and generate significant tax savings is going to take a little bit of work and a little bit of administrative effort. But again, that's where the big savings is going to come. So, again, the work must be real. It's got to be documented. You can't say, hey, I'm hiring my 6-year-old to come in and clean my office, right? I've got my youngest child is 9, and my kids are better even when they are trying to clean at making messes than cleaning. And so again, if you say, I've got a 4-year-old and a 6-year-old, and they're going to come in and they're going to be my office cleaner, and I'm going to pay them $16,000 a year. That's probably not realistic, right? So it needs to be reasonable. They need to be able to perform the services. Now, can you find things that, an 8 or 9-year-old can do? Sure. Maybe you have them come in and shred papers for you. Maybe you have them come in and they can help clean, dust the desk off or something like that. But again, you want to make sure that's documented. Make sure it's age appropriate. You want to actually go through the process of issuing a W-2, reporting those wages. Again, depending on the structure, they may or may not be subject to those FICA taxes. You want to make sure that they actually receive the funds. And so whether it's setting up a separate account for them or making sure that you're differentiating and saying, this is the amount that's being paid to you. This is going into your savings account, and now we're making the contribution to the IRA out of that. Again, just show that paper trail. Um, One of the other things that we see a lot, again, I mentioned it, but just want to, I love to harp on it is, again, it's got to be real documented work. So the question we get almost all the time is, okay, well, I'm going to pay my child to be a model. I'm going to take their picture and I'm going to put it on my website and I'm going to pay them $16,000 for that. And so again, now if your child is doing modeling and they've got other contracts and they're doing that for other entities, maybe I could get behind that. But again, if that is the only gig they have is the one that is your business, then the IRS is going to put some scrutiny on that. So I'd be careful with that one. Yep, next slide. So again, these are again just some examples. I would say it's always worth a conversation. But again, as your children get older, obviously there's more things that they can do, more responsibilities that you can give them. And I mentioned this, but to me, this is a good way not only to show them the value of putting some work in and work ethic, but again, the value of responsibility. It's not just like, hey, yeah, you're working for me and you don't really have to come in and do anything and I'm just going to pay you. So, really have them come in, have them do the work, have them, clean the office, have them answer the phones, have them, help you update your website if they're into IT and technology and things like that. So find something that's specific, something that they will like and learn some skills, because again, that it will not only behoove them from an income tax standpoint and you, but it will, instill those values in them so that when they go out into the real world, they know what it's like to work. So again, simple example, won't spend a lot of time on here. This is just an example of paying your children 12 grand. Again, if you don't do it, then you're paying tax on that $12,000. If you move that to them, again, it's a deduction for you. It's not going to be income taxable to them because again, it's under that threshold. And again, assuming that you're paying it out of a sole proprietorship, it's not even going to be subject to the FICA taxes. So that's about a $3,800 savings for you because again, now you're deducting that by the business. And so if they were to take that $12,000 and again invest 7,500 into a Roth IRA, even if it just earns 7.5%, and they never put anything else into it, you see that could grow to around $200,000, and now that's all tax free to them. So that to me, like I mentioned it, I just want to continue to harp on that. The real power is in the ability to put that money into a Roth IRA. And again, if you want to just do something like a mutual fund, that's great. But if you want to really try and power it, you can even self-direct that and maybe get even better growth on that. Quick slide on entity considerations. Again, I've mentioned a lot of this. Sole proprietor, a single member is the most efficient because again, it's not going to be subject to that FICA tax if they're under 18. Depending on if you're an S corp or a partnership, again, with an S corp, it's not going to be subject to or not going to be eligible for that FICA exemption. With any of them, you do want to run, proper payroll, make sure they're getting W-2s and documenting all that. Next slide. And I think that's me. I'm going to shift it over to Danielle. I'll come back at the end to hit on some retirement strategies and different types of accounts and how to maximize those. But I'm going to turn it over to Danielle, and she's going to get into some real estate strategies.
Okay, amazing information, Jason, and super actionable. A lot of people talk about things like kids on payroll, but rarely do they talk about how to actually pay the kids on payroll and what are the true activities that are legally eligible. At our firm, we have former IRS tax attorneys in addition to CPAs as well. So we are really, really critical. So some of the things that people may push that are gray, we do believe in playing in the gray to a certain extent, of course, because when you're too cookie cutter, of course, you're going to miss out on things. And we do everything by case law and making sure that there is reason behind and there's true audit proof circumstances and trails when it comes to putting in action any of these strategies that we have in place. None of these are gray areas, to be clear. None of these at all. These are all written in the tax code, so these are not loopholes or anything like that. You may hear them on TikTok or Instagram or wherever you consume your short information called different names, but those are iterations of the truth, and these are true IRS and RC codes that are written into the tax code. So let's jump back over to the chat real quick. I want to get a gauge. Who here owns a piece of real estate that's considered an investment property? If you have one, put one in the chat. If you have two, put two. However many you have, if you can't count on two hands, then put 10 plus. But let me know who here owns a piece of real estate that's considered an investment property, not your primary residence, a secondary property that you maybe rent out or you're flipping or something like that. Paul has five, Terry has one. James has four, Brian 25, whoo, Andy 40, Roxana has six, Luba has one, Stacy has five, James has 70. Wow. We have multiple for Howard. Alan has six. Charles has four. We have someone with zero. That's okay too. Doug has more than 10. Amazing. Okay, so some of you may be familiar with some of these strategies here, but again, stay with us through the end because I'm sure you'll learn a little trick here. Just like another thing that Jason spoke about with the known as the Augusta rules, not a lot of people talk about the fact that it's available for not just business owners, right? So that's my goal here tonight with you or today. And we're going to just kind of fly through this quick, a lot of information, but again, keep that workbook handy so you could take notes and stay with us to the end and we'll give you a synopsis of everything we're talking about here to make it truly actionable. We call it our proactive tax strategy map. Jason gave it away earlier, so I'll piggyback on that. But right now we're going to focus on real estate. So this is what I call the trifecta. And the trifecta means that you're gaining some kind of status, like real estate professional status, along with cost segregation and bonus depreciation. Okay, I'm going to jump into what all this means for you. So here's the dilemma. This is maybe what you're facing, right? Hopefully, it's a good problem. You're earning money, which means that you're profitable, whether you're a W-2 owner or a business owner. And of course, the IRS is going to have to take their cut. The more you make, the more they take, right? Your tax brackets will go up. So, how do you position real estate to work to your advantage? Not just from a tax standpoint, because we don't want to make big moves just for tax optimization. We want them to cash flow as well, right? So you want to look at it from an investment standpoint as well. Okay, my slides are a little delayed. So the best way to understand this is think about it, there's two buckets, right? So you have bucket number one is what we call the active income. And bucket number two is what we call passive income and expenses, right? So your active income, if you see my screen, let's say red bucket right here. This means that you are a W-2, you're getting W-2 wages in, commissions, salary. Even if you're a business owner, that's active income. Like when we make money at Oro, that is active income for us as business owners, right? That all falls into the red bucket, which is the IRS tax bucket. The IRS is automatically going to get their fair share there. But there's different things that you can put in place to what I call closing the valve to stop that bucket from filling up. In order to get to that point where you can close that valve so the IRS bucket doesn't fill up at that 35%, real estate is one of those phenomenal ways. Now, what happens is the IRS dominates and decides that real estate is considered passive activity, which means that passive activity generally stays in a separate bucket from active activity. So if you have expenses in your real estate and you have a loss, that generally cannot just automatically offset your active income. People get this twisted that don't understand. They hear investing in real estate is great for taxes. And I see this all the time as a CPA with other CPAs that they'll file tax returns, but they're not utilizing the real estate that these individuals are buying to benefit them from a tax perspective. Because what has to happen is that valve needs to get opened so that those passive losses, that passive activity that happens in real estate can go into the red bucket and offset the active income. I'll explain what this means in more detail. So, how do you become to the point where you're taking that passive income and offset the active income? There's two ways. One is something called real estate professional status, and the other one is called the short-term rental activity. I hate this word loophole, but this is how you're going to see it all over the internet. So I'm going to call it that just for conversation and relatability purposes. But it is regulation section 1.469-1T. and that is the short-term rental exception. Okay. So real estate professional status, short-term rental loophole. Now, you do not need to be a real estate agent. You do not have to have a broker's license, and that doesn't even need to be your only gig, right? There's different ways to retain real estate professional status. But essentially, what the IRS says is it's real estate is considered passive activity unless one of these two exceptions happen, which means that you gain status as a real estate professional in the eyes of an IRS, or you're able to make the exception for short-term rental exception. So I'll jump into more examples of what this looks like. So let's start with the first one, real estate professional status. What is it, and how do you maintain and achieve eligibility? Okay, so there's really three rules, and these three things have to happen together. It's not one or two and just one. It's none of that. It's all three of these have to happen together. So the first one is going to be to have at least 750 hours in a calendar year that you're working on what's considered eligible real estate activities. The second thing is going to be the 50% rule, which means more than half of your time is spent in real estate. So this is really hard to get the status if you're a W-2 employee for real estate professional. But I did promise you if you're W-2, I do have something else for you. So there's another way to get it. Hang on. But it's very, very challenging because think about it. If you're working 40 hours a week, you have to be spending more than half of your time in real estate. So you need to be spending 41 hours a week into real estate activities. And that's 81 hours right there, working a full-time job. And that's a lot of work. And I hope you're not doing that unless it's really worth it and it's temporary. But again, it's 50% or more of your time and 750 hours. And then you have to hit something called material participation. And there's seven different qualifiers when it comes to material participation. I'll walk you through those momentarily. So real estate professional status. If that doesn't sound like something that you can meet personally, it actually allows you, if you're married filing jointly, if your spouse can meet it. So in my example, I'm a real estate investor as well, and we own a bunch of short-term and long-term rentals. But I cannot get real estate professional status because I'm here working at Oro. I'm a CPA, entrepreneur, and this is where I spend more than 480 hours a week. So there's no way I can top that in real estate right now, nor do I want to. But my husband can, and my husband does, right? So because he's the one that goes out and fixes the short-term rentals, he's the one that's managing the day-to-day. He's the one that's also analyzing the books with us, right? Like I still have involvement, but he's the one that dominates and meets the material participation test and his qualifiers. That's what he does full time for us. So because he gets that status, because we're married filing jointly, we get it together. And because of that, any investments that we make in real estate can offset the active income that comes in from my business as well. So that's how you get around it if you're not real estate professional status, but if you're married, and if you're neither of those things, then this could potentially be for you. And hey, if you're neither of those things also, I want to say things change, right? Like as we go through life, like, and we look for investments and this becomes interested for you, knowing this information now is super useful for you as you make decisions in the future. As I mentioned, you never want to make a big decision just for a tax break. You want to make sure you're investing in property that cash flows, that has good appreciation as well. You're not just sitting there to just beat the IRS and say, I gotcha, right? So the second thing is the short-term rental exception, right? This is properly stated here, got rid of the word loophole, but different rulings, but you do have to meet material participation here as well. The way that this works is the IRS looked at hotels, right, in the past, and that is a true business, right? And it's different than passive rules because a hotel, what happens? You need to change sheets like regularly, daily, right? There is a cleaning person that comes in. There is someone at the front desk. There's no question about it. A hotel is a true business, and Airbnbs fall under that same exception. As I say, Airbnbs, it could be VRBOs, short-term rentals, right? So what the IRS wants to see is a few things have to happen here. One thing is that they want to see 7 days or less as the average stay in the home. So if you're renting out a property more than 7 days, that's okay for a week, but over average, if you're going to take the amount of rentals you had for the year and divide it by the average stay, it has to be 7 days or less, or otherwise you are not considered a short-term rental. That is how you're going to get categorized in the eyes of the IRS, okay? So if you can't meet those tests with putting in more than half of your time, etc. This rule is a way that you can get around that. So technically, you can buy a property. I bought the last one in December for 1.9 million. It was a $2 million property. And I was able to do a cost seg on it, and I rented it out as an Airbnb those last just few weeks of December. And I'm able to get the STR like push through doing a cost segregation study with bonus depreciation to offset my prior year income because I purchased a true short-term rental. And again, this doesn't have to be done throughout a certain time in the year. It doesn't have to be January. You can buy the property in October or November as long as you meet the standards that you're eligible for with the IRS. So if you're a W-2 employee, this is how people get around the STR, but you have to meet material participation. And there's 7 different areas where you can meet that. One of the most common one is that you're doing more work than anybody else on that property. So in December, I had no property management happening. I was renting it out myself. There was no way anyone was going to trump me on time. I was renovating it at the same time. So, as we rented, just from an aesthetic purpose. So as we did that, we were able to maintain the eligibility for material participation along with meeting that average stay being 7 days or less. So when it comes to making a decision of which one makes sense for you, here's a quick side by side. And again, you guys have the workbook as well, so make sure you have that handy and analyze this afterwards. It's one thing to take information in and consume, but it's another thing to reflect on it, take time out, study it, write the lessons that you believe that you learned. The sooner the better while it's in your head, and come back to us with questions, okay? We're on, you could find us in the community, which we'll drop later in a little bit. But also, we're on social media. You can find us on Instagram or even LinkedIn, right? Those are other ways to connect with us outside of here as well. So make sure we're always posting quick tips and tricks. Make sure you find us on there as well. So this is what I call the diagnostic matrix, and this is which key fits into your vault. As I mentioned, the 2 keys before: real estate professional status, short-term rental loophole. Guys, I'm giving you a high level. I can do an entire 2 hours on each one of these, but I'm going to let you know the caveat is you can't just leave here tonight and say this is the only one. You have to do due diligence and research because there is tracking, there is documentation. If you ever got audited, you want to be able to prove easily your time being tracked properly. So this is a nice side by side to see which one could I potentially be eligible from. Not right now. Could I make different changes, or can I invest in something and maintain this status? I make investments towards the end of the year personally based on how much I'm going to owe in taxes, and real estate is one of the top vehicles that I use because, as I mentioned, I am a real estate investor, so I prefer to invest that way, and I like to have assets that appreciate as well. I don't believe that there is a such thing as passive real estate, though, in my eyes. It just hasn't happened. I've never had a house that you just never hear anything from. So if you have one, God bless. All right, so I know my guys with 70 properties or more can feel me on that one. Cost seg. Okay, what is this, right? Real high level. I could do 2 hours on this alone, but the way that it works, the nature of the beast, when you're investing in a property, the IRS is going to allow you, if it's considered a single family home, or even sometimes up to like 2 or 3 units, you're going to get 27.5 year life to depreciate over the value of the home base. So what does that mean? You have the value of the home, let's say it's $600,000. You remove out any land. Let's say the land was $100,000. The home base is $500,000, right? So now the IRS allows you to take that $500,000 home base, divide it over 27.5 year, and now you get this deduction that doesn't cost you any more money. You don't have to buy anything to get that. It's not like you have to buy equipment or a car to get an extra deduction. It's because you already purchased the home, and that gets spread out over 27.5 years. What cost segregation does is, this is actually written in the IRS codes. It's considered the proper way to categorize the cost within the home. That's why it's segregated into the primary properties that it should be in. For example, you have a dishwasher, right? Does a dishwasher last 27.5 years? What about your cabinets? Do those last 27.5 years on average? Carpets, 27.5 years? Generally, no, right? Those are going to go into different categories, maybe 5 year categories or 10 year categories. So it's the proper reclassification. As you buy a home, everything in it falls into 27.5 year. You're going to be writing off a refrigerator for $50, a year, which is ridiculous, when you can get it all put into the proper categories that it actually truly belongs in. But no accountant will automatically do that. Instead, you get something called a cost segregation study, which is done through a third party. We actually do them at Aura with our sister company as well. So we do these for anyone that has investment properties. And we look at everything. So we send out an engineer. They analyze everything. They'll look at the HVACs. They'll look at even your sidewalks and your fencing and things like that. You could see in my picture here, the things on top are generally considered 5 to 7 year properties, sometimes 15 years. And then the things on the bottom, which are more structural, that's your foundation, that's your walls. Those are things that are going to be 27.5 years. Generally, what I see is about 20 to 30% of the home base cost. So if it's 500,000, generally 20 to 30% of that cost can get reclassified into a shorter bucket. Now, what happens if you move all that into a shorter bucket of 5 or 7.5 years? Massive, massive write-off. That's what happens. And this is called a paper loss. This is why real estate changes the game when it comes to tax strategy, because you can push out something that doesn't actually cost you any more money in a property you wanted to invest in anyway, that cash flows hopefully every single month for you. And in addition to that, you get rewarded with a paper loss that gets to offset. If you have one of those two keys to unlock that valve, that gets to offset your active income. That's how it works. Now, thanks to the new big beautiful bill that Trump passed, bonus depreciation is here. It's restored. And what that means is you would have had to take that accelerated depreciation. I call it depreciation on steroids, right? Moving it from that 27.5 year bucket to a 5 year, 10 year, or 15 year. And you still would have had to divide it by that 5 year, 10 year, 15 year, which is better than 27.5. But now the law says that if you purchase the home within that one first year, the year that you actually incur the cost, you can write off 100% of the depreciation in those buckets in the current year. So instead of having divided over 5 years, you now get massive, massive, massive front loading. So if you look at the picture that I have in front of you, this is just showing a visual where there's a massive, massive offset in the beginning, and you'll feel that definitely year one. You'll feel it again in the first few years, but it will give you a smaller depreciation in the future, right? And if you go to sell it, if you're going to sell the property in the next 2 years, this may not be worth doing because you will have to do something called depreciation recapture. So it's not a permanent solution unless you're going to keep the property for 27.5 years, or you can 1031, which means buy another property that's greater than or equal to a value within a certain time period, and then you don't have to pay any taxes at all. But I don't want to get that detailed today because I'm just trying to give you guys a masterclass more of a high level, but with actionable information enough to see what interests you, to bring this information that the wealthy are utilizing from tax strategy and planning and put it in front of you guys so that you can decide what may work for you when you build your tax strategy home. So let's look at some numbers real quick. All right, so we got here, this is an example. On the left, I have no strategy. I call it the trifecta. Again, that means a status of one of the two keys, real estate or STR, and that means we're going to have bonus and you're going to have cost seg. All those three things together, that is what I call the trifecta. So in this example, we purchased a investment property for $600,000. The depreciable basis is $480,000. What does that mean? That means the land was worth $120,000. So remove that out. $480,000 is the cost of the home as if there was no land, right? So, and in the example where you didn't have a tax strategy in place, and I see people all the time invest in cost segregation strategies that aren't eligible because they don't have the status. They give it to their accountant and then they're so confused why they have to pay taxes. And it's because there wasn't a status, or sometimes their accountant doesn't understand it properly and it just never gets applied. You have to check off certain boxes and make certain moves in order to get the eligibility. In this example here, the deduction over a 27.5 year life, you take that 480 divided by 27.5, and you would have about a $17,000 deduction. And that's great, right? Because it's better than nothing. But from a tax bracket standpoint, all that would save you was about $6,000, right? And if you can even offset it, right? That's the other thing. Because if it's passive and you don't have real estate professional status and you're not maintaining short-term rental exception, then that just stays there and you have a loss. Let's say it's a loss that will stay there until you sell the property one day or you have some kind of passive transaction that happens to offset it. And then for the trifecta, if you look at the alternative here, same exact facts. 600,000 is the purchase price, 480,000 is depreciable basis. And we're going to reclassify now with a cost segregation study. About 180,000 is going to get reclassified to 5 year, 15 year property, right? Thankfully, it's a big, beautiful bill. We have bonus appreciation, and we can take off that full 180,000, let's say in this example, up front, right, in year one. And this is going to save you. This is not deductions. This is dollar for dollar tax savings of $63,000. So instead of you writing a check to the IRS for $70,000, you now have an offset of $63,000. The deduction here would be what, $300,000 of a deduction difference if you look at that. So it's just super powerful, right? And here's another one. I'll give you one more quick example. I won't run through this whole thing, but this is if you had that short-term rental in place. This is for my people that are W-2. If you're not W-2, you could still do this too, just to be clear. But 100,000 of a W-2, you put in the same strategies in place. The difference is you have a short-term rental loophole. And this is going to get offset your active W-2 income if you can truly meet the exception of short-term rental in the eyes of the IRS. So as you look at a side by side here, you're going to want to look at W-2 earners, and this is going to be anyone that's paying any dollars in taxes. And when you think about dollars in taxes, you're also going to want to look at what's coming out of your paycheck every single week because that counts too, right? So the challenge is you have little time and you have heavy W-2 income and a higher tax burden, right? So you don't want to waste your time on real estate professional status because that's more time cumbersome. But maybe a short-term rental, if you can meet that exception and you're interested in investing in them, then maybe that would be a better strategy for you. For people that are more interested in getting more involved with real estate, then that's where you would look at real estate professional status as well. And as I mentioned, I consider myself a hybrid household because I'm W-2 and business owner because we pay ourselves on, actually, no, I'm not anymore. We do it, I have two different companies. On Oro, we're partners, so we do it just through distributions basically, like guaranteed payments. And then on my other company, that was W-2. So we're completely hybrid there. My husband has the real estate professional status and it works for us. So I'm going to jump back over to Jason right now, and we're going to jump into a few more of this is we're going to get a little bit deeper and a little bit more advanced, and then we're going to provide you with that promised incredible proactive tax strategy map. It's our business life cycle. This is again for business owners and also aspiring business owners, W-2. Anything that we're mentioning here and more is going to be in that resource. But let's jump back into it. Jason's going to go over a few things quick, then I'll jump back in and show you a really incredible example. And we'll send you guys on your way with real actionable items, only for those of you who stay with us till the end.
Thank you, Danielle. So again, really, this is kind of a summary of what we've talked about so far. And so, it's an easy way to kind of look and see, you know, do any of these things apply to me? And if so, what are some things that I can do right now? And again, whether it's, you know, as a W-2 employee, as a business owner, again, a lot of things like Danielle mentioned are geared toward business owners. That's where the big benefits come and some of these big strategies can come into play. But there are things that can apply to just W-2s as well, or somebody that's even just starting a business. So again, look at this, use this as an example and kind of a quick cheat sheet and see like, hey, does any of this apply to me? Okay, yes, I can, for instance, hey, I'm a W-2 only, but I own my own home. And really, even if you don't own your own home, you could use a Augusta rule on a home that you're renting. But again, think of the ways, especially for those business owners, that you can put some of these into place. Okay, next slide. So I'm going to get into some specifics around additional tax-free accounts geared mostly toward retirement accounts. And again, some of this will be a little bit basic, and then we'll build on it and kind of go into some more advanced stuff as we go. But again, just based on a lot of the questions that we get from clients that come in from all different aspects, some of this, even though it may seem basic to some people that have, for instance, had a Roth IRA forever. There may be some that don't fully understand the difference between a traditional and a Roth, or frankly understand the power. And so I want to just mention, again, Danielle mentioned at the beginning, specifically Peter Thiel, and I think that's the one example that most people hear about and kind of see the power. And as we talk, and we'll start talking about being able to self-direct some of these accounts as well. That's where, the ability to really earn some returns and really generate wealth comes from. But I think it's, the 5 billion number or whatever gets a huge, huge play. But even just the first transaction, like thinking about how much wealth that created. So she mentioned it, he started his Roth IRA with $1,700. So he bought the shares of PayPal for $1,700 before they went public. They, went public, sold to eBay. And so when that first transaction happened, that $1,700 had turned into $55 million dollars. So just that one transaction alone, the fact that he did that inside of his Roth IRA instead of outside of a tax-free account, saved him over $13 million dollars in taxes. So you can see, like, that's the wild example, right? Of where this can become so powerful. But even if you're not hitting the jackpot like he did, and getting in on something like PayPal or Facebook pre-IPO, investing in real estate has the ability to generate some good returns as well. So, um, oh, we lost our slides, Danielle. Thank you. So just to get to some basics on traditional versus Roth, again, traditional, think of it as pre-tax. So either when it goes in, it's going to reduce your current income. Again, there are certain thresholds once you're over a certain AGI or adjusted gross income limit, where even the traditional will not give you a tax deduction. But in most cases, if you're under those thresholds, you'll get a tax deduction for anything that goes into a traditional IRA. So again, reduces your current income, but it is tax deferred only until withdrawal. So that's the big difference, right? As with the Roth, it goes in, it's after tax, so you get no current deduction, but it's tax free forever. So specifically on something like, the Peter Thiel example, like if that was in a traditional, it would have been great because it's still growing. But as he starts taking that money out, he would be paying tax on that at that point. Whereas in his case, because it was in a Roth, it's tax free forever. The other big one that's different between the two is as it relates to RMDs or required minimum distributions. With the traditional, those are required at age 73. You have to start taking that money out. And the amount is based on your life expectancy at that age. And so the IRS has tables. So you look at what the balance is, you multiply it by that life expectancy value from the table, and that gives you the required minimum amount that you've got to take out. Now you can take out more than that, but that RMD is the required minimum amount that you have to start taking out. And whereas with a Roth, there are no RMDs, and so again, not if you don't need it, it can continue to grow tax free and then pass on to your heirs. There are strategies around RMDs, not something that we're going to get into today specifically. Um, but if you're at the point where you do have traditional money and you are at the age where you're gonna start taking those RMDs, there are things that you can do to kind of minimize some of the tax on that. Things like what's called a qualified charitable distribution. So instead of you taking that, it goes directly to a charity. So again, if that's something that you're inclined to give anyway, and you're at the point where you've got to take RMDs, that would be something you should consider as well. All right, next slide.
Yeah, I want to say one thing real quick. So, we hear this all the time because we get clients that come in, and a lot of people feel like they have like skeletons in their closet where they feel ashamed that they didn't know about some of these things, or that maybe they wish that they started this earlier because you see the things when it comes to accumulation of where it could be today if you started consistently and accumulated 20 years ago. But at any age, it's not too late to do this. And there's actually benefits and catch ups for the future as well. So I'd love everyone to just be like truly honest and authentic and just jump into the chat. And like, how do you feel about your status of your retirement? Do you feel truly that you're set up for success as is? Do you feel there's more work to do? Do you feel that you wish you did a little bit more? Like truly, like what if you had a word or two, what would that emotion feel like for you right now when it comes to the status of of your retirement in an authentic way. We're not here to sugarcoat anything. We're here to make a difference, right? And as I mentioned, there's no age that's too old. There's definitely no age that's too young, for sure, to start any of these things.
Yeah, that's a great point, Danielle. And I had a similar conversation with a client, as we came up to April 15th and the tax filing. And it was something where they were in a situation where, we didn't engage, right? So we just got brought on kind of after the year was over last year. So we're working with their return after the fact. Not a lot you can do from a planning standpoint after the year's already over. But we were working through it, and we got ready to file the extension. And we're like, hey, look, here's the amount that you've got to pay. And they're like, oh, geez, I don't know how we're going to do that. We don't have that set aside. We're going to have to sell, some other assets that we have or whatever. And so we got to talking about the ability for them, because they do have a business, to set up and maybe put money into a retirement account. And they were kind of like, well, yes, I understand that, but then we got to come up with the money to put into the retirement account, right? So they're in the same situation where the cash flow just wasn't there that they could, make that contribution immediately. And so I was grateful of that conversation, because one, they were being open and honest with me about, look, like, we don't have the cash to pay the tax or the retirement contribution right now, right? And so that's a perfectly legitimate concern, right? It doesn't mean that it's right, wrong, or whatever. It's just it is what it is. But we started having the conversation now that I understood that, and said, okay, well, look, here's one of the benefits of doing this retirement contribution instead of paying that money to the IRS. By doing this and filing the extension, you now have until the extended due date to make that retirement contribution, and it still counts for 2025. So instead of having to come up with money to pay with the extension to the IRS in April, or if you don't have that money, then you're going to get, interest and penalties and all that. Let's instead declare that you're going to make a retirement contribution of whatever the amount was. That's going to reduce the tax that you owe to a manageable amount. And now you have 6 months to plan and come up with the cash to make that retirement contribution. Now, ideally, yes, you get it in there before, because then you can invest it and all that. But worst case, now you've got 6 months to plan to come up with those funds, and it's going into a retirement account for you instead of to the IRS. So great point about, just being open and honest. And again, like, that's the only way that we can really help our clients, is if we know all of their situation, and not just like, hey, here's the accounts I have, or here's how much cash I have, or whatever. But that's one of the things that we start with all of our advisory clients, is like, what does success mean to you? And so for some clients, that may mean making as much money as I can. For some, it may mean setting my kids up for the future. For some, it may mean, I want to make as much money as I can so I can give it all away to a charity, right? And so, knowing what success is to you, and what you're working with, allows us to craft those strategies, and craft your plan. So good point. Um, so back to the slides, and specifically self-directing. So we want to talk on this because, again, this is something that not a lot of people, and even really not a lot of CPAs, are familiar with. And so when we talk about self-directed, it's funny because as a CPA, you talk to a lot of wealth managers, wealth advisors, and things like that. And so, that's one of the things that I've asked around as I meet people, and they're like, oh yeah, I do this or do that. And, I kind of ask them like, well, what's your take on self-directing? Do you have many clients that do that? Is it something that you are familiar with, et cetera? And so, a lot of times when that term self-directed comes up, people think, oh, well, you mean like pick the stocks and stuff that I invest in, or pick what mutual funds I invest in. And I'm like, well, I guess technically, yes, that kind of means that. But when we talk about self-directing, we're typically talking about doing some type of alternative investing, or investing in alternative assets. And so that's where the Peter Thiel example, it specifically came in, right? He had a Roth IRA. He was not investing in an S&P 500, mutual fund, right? He invested in PayPal, in shares of PayPal when it was basically a startup company pre-IPO. And so being able to self-direct your retirement accounts or HSAs or other types of accounts that allow for self-directing allows you to invest in things like private equity, other companies that aren't public yet, or even companies that are public. Real estate is a big one. We have clients that are very active in the real estate market. Danielle went through some of those examples. Now, again, if you're looking at investing in real estate and trying to qualify for reps for specifically for the tax advantages, doing it in an IRA may not be the best route because again, typically now again we won't get into considerations of UBIT and all that, but a lot of times, if there's income or losses, those income or losses are not going to affect you personally because it's in your IRA. So that may not make the most sense if you're looking for real estate as a way to reduce other income. But if you know this is something that, I'm going to flip it, it's going to substantially appreciate in value, then, doing it inside of an IRA may be something that you want to consider. And then again, precious metals, crypto, tax liens, there are many different types of alternative investments that you can do within an IRA that again, I always tell clients like if this is something that you're doing already, or something that you're interested in and something that you're knowledgeable in, maybe it makes sense to do inside of your IRA. If you're telling me that, hey, I've never dealt with tax liens before, I'm gonna, do that in some IRA. I would say maybe you should learn about it a little bit first, before you put your retirement account up, and subjected to that. But again, if it's something you're familiar with and doing already and making money in that already, consider doing that inside of an IRA will just, again, uh, shelter that income. And especially if it's a Roth, then it's not going to be subject to that at all. You do have to be aware of prohibited transactions. And so that's something that you want to be, very aware of anytime you are doing these alternative investments inside of an IRA. Because again, when you do that inside of an IRA, the risk is that when you have a prohibited transaction, it essentially blows up the IRA. And so if those prohibited transactions happen and come to light and the IRS realizes it, then essentially the IRA goes away. You pay tax on anything that's in there immediately, and that's obviously not a good result. So you'll see some of those listed on the right. Those are certainly not all of the prohibited transactions, but you got to be very careful, specifically when it comes to self-dealing and dealing with disqualified persons. And so that's something that we also will talk with clients about. Who is a disqualified person? Can I do that with, my cousin-in-law? Can I do that with my brother? Can I do it with my parent? And so talking through all of those different scenarios, what is the transaction that you're looking to do and who are you looking to do it with? Because again, you want to make sure that you avoid any of those prohibited transactions. Next slide. Yep. Okay, solo 401k. This is one that we really like. And again, there are many different types of retirement accounts that you can put in place as a business owner, that will allow for larger contributions than just the traditional and the Roth that we talked about, which is again limited to 7,000, 8,000 if you're over 50. Um, but the solo 401k is by far and away one of our favorites because the contribution limit, as you see, is pretty high. $72,000 is the max if you're under 50. It goes all the way up to $80,000 if you're over 50. And then there's a certain range between 60 and 63 where that number goes up even higher. And so that's in place for a few years. And so this is one where it works really well. Obviously, the term solo 401k, it works very similar to a normal 401k that you may or may not be familiar with if you're at a company that has a 401k. With the solo 401k, all that means is that you are the only participant, right? So if you have employees in your business, then a solo 401k is not going to be an option for you. But if you do not have employees, then the solo 401k is going to be a very powerful option because again, you can contribute for yourself. There's the employee portion of that. So again, the deferral, just like as if you are participating in a 401k, at a job that you are not an owner of. So you have both the employee portion and the full employer portion. And so you'll see there up at the top right, depending on what type of entity you have, that employer portion is calculated differently. So if you're a corporation like a S Corp, that's going to be based on your W-2 compensation. So again, that may be a situation where, paying yourself an unreasonably low salary, again, it may not limit you not only from the QBI standpoint that we talked about, but you may also limit yourself from the amount of employer 401k money that can go into the solo 401k because it's based on your W-2 compensation. Um, so again, if we look at an example in the middle there, it kind of walks through an example of a sole proprietorship. There's a formula that you calculate. It's essentially works out to 92 of around 92% of your self-employment income multiplied by 20%. So you take your self-employment income, $200,000, multiply it by the 92.35% times 20% comes out to about a $36,000 employer contribution. Plus, again, the employee deferral that you're allowed, the 24/5. So at that $200,000 of profit, you could put away $61,000 into a solo 401k. And now it's in the solo 401k. You couple that with the ability to self-direct, and now you can take that $61,000 and invest that in real estate, or again, maybe you're friends with someone who's creating the next PayPal, and you can be the next Peter Thiel. So that's where the self-directing really is powerful because again, not that investing in mutual funds or whatever is wrong, but you're not going to be able to generate those types of returns that you saw on something like what the Peter Thiel example. Some advantages, again, there are Roth options for the solo 401k. That's all based on the plan document that's put in place. There are loan provisions. One thing, again, I mentioned unrelated business income tax or UBIT as it relates to investing in real estate inside of an IRA. As it relates to specifically debt financed real estate, that is something that inside of a solo 401k that is not subject to UBIT like it is in an IRA. So again, kind of outside the scope of what we're talking about today, but those are topics that we talk about with our clients all the time. So if you've got an instance where you've got debt financed real estate inside of an IRA, you may have UBIT considerations that you've got to consider. Other type of investments like private equity that can sometimes generate UBIT as well. So just make sure, again, something I wanted to mention that one of the advantages of the 401k is that for that debt finance real estate specifically, it is not subject to UBIT inside of 401k like it is an IRA. And then again, just considerations if you have employees, then the solo 401k is not going to be an option. You can do what's typically called or referred to as a safe harbor plan. And that's going to work similar to, a 401k that you may be familiar with if you're a W-2 employee or been at an employer that offers a 401k. And really the biggest difference is that with the safe harbor plan, there is some typically requirement to potentially contribute to your employees. So you can't just contribute to your own account and not your employee's account in most cases. One thing to consider with the solo 401k that is good to mention, your spouse can participate if they are. So that's the one kind of exclusion. So your spouse can be an employee and that you can still have a solo 401k. So important to mention that as well. And then lastly, we'll hit on Robs. So again, Robs is something that we could probably spend an hour or 2 hours on alone. So we're not going to do a deep dive here, but it is something that we wanted to mention because we get a lot of questions and have a lot of clients that are interested in that. So Robs, as you see, stands for Rollover Business Startup. And this is an interesting structure where you essentially have a business that is a C corporation that is owned primarily by a 401k. And so, again, this is very powerful in the sense of yes, you're going to generate profit inside that 401k, or excuse me, inside the C Corp. And I think we hear this, I heard this my entire career, like C corps are not ideal because you have that double layer of tax, right? You're paying tax at the corporate level, and then when you try and get the profit out to the shareholders, that's got to come out either as salary or as a dividend. And if that C corp is owned by individuals, then yes, that's two layers of tax. You're paying tax at the corporate level, and you're paying tax at the individual level when you receive that dividend. So that's where the big benefit of the ROBS is that it's owned primarily by the 401k. And the big difference is when that 401k is a Roth 401k, then any distribution or dividend that comes out of the C Corp after that 21% goes into the 401k. And if that's a Roth 401k, then you're not subject to that double layer of tax. It's going back in there tax free. The other thing that's important to mention, we just talked about the limit, right? There's a $72,000 limit that you can contribute directly to a 401k plan. The IRAs we talked about, it's even lower, 7,000. With the ROBS, there is no limit to the amount that can get back in there from that dividend that's made from the C Corp. So your C corporation earns $1 million of profit. It pays, $210,000 of tax. Now it's got $790,000 of profit. 90, again, assuming the 401k owns 98% of that. 98% of that $790,000 can go back into the 401k, and it's now in there tax free. And you can use that to invest in whatever you want to invest in. So this is a very, very powerful tool. There again are significant risk and scrutiny around this. A lot of where we say, Danielle mentioned playing in the gray. A lot of the reason why everything and a lot of the things around Rob's are gray is just because there's not been a lot of tax law or tax cases around this. And so this is one where there is opportunity, if you will, and if you're willing to take advantage of some of that. I don't know if risk is the right word, but just uncertainty in the fact that there's not a lot of case law around these. But again, there are certain things that you can and can't do. And so again, some of those prohibited transactions that we talked about specifically on the IRAs come into play with the ROBs as well. So you've got to be careful there. Um, but again, this is something that we are very familiar with. We advise clients on this. I had two calls just yesterday where we're helping clients walk through getting the ROB set up. And I think that's the hardest part, right? Is the implementation. Once it's set up and it's operating, the business operates very similar to a normal everyday business. Again, you've got to be careful with the prohibited transactions and things. But from the standpoint of generating revenue, deducting expenses, and operating, it operates very similar to a normal business because it's a C corporation. The biggest difference is that it's just owned by primarily the 401k instead of an individual. So that's where we see a lot of clients stumble and get frustrated is in just the setup piece because, once it's set up and operating, they know how to run the business. But it can be a little bit of a hassle to get it set up. So we have a lot of experience and a lot of expertise helping clients do that. Next up, or next slide, and I think, yeah. So this is kind of just to wrap it up. Again, a lot of this stuff we already talked about, but again, take a screenshot of this if you want, because again, it kind of goes through the contribution limits for the different types of accounts. The taxability of those, the taxability of the growth. Can you self-direct it? All that kind of stuff. And again, Danielle mentioned the resource. Within that resource, there is some interaction again where you can kind of say, do I have employees? Do I not have employees? And it will kind of help you walk through what retirement account may be best for you. Again, I would say use it as a tool. It's only a tool. It would not, I would say, take the place of an in-depth conversation with one of us at Oro. So you can certainly use that to get a little bit of guidance, but it's not going to be able to answer specific questions like we would. So happy to share that and use it with you, and hopefully you guys can use that as a resource. But again, as questions come up as you walk through that, that would be the time that it would make sense to try and reach out and have a conversation with one of us. So.